Well, I think one of the interesting plays going forwards will be what the United States does about the strategic minerals. The fact is they've now made it a strategic mineral, which doesn't mean to say they've started buying it, or at least we have no evidence that they have. But what that does is it opens the door for government agencies, such as the military, to stockpile silver.
And I think the heart of your question is, will coming new mine supply solve this supply-demand imbalance over the short term? And I think the simple answer is no. There's a lot of newcomers to the silver space, and I've even heard some generalist kind of financial advisors say, oh, well, new mine supply is going to come on.
Well, I suppose the direction of travel upwards was not at all surprising. I mean, that's been widely flagged and for some years. And we've known that silver's been in short supply relative to the industrial use of silver. So it was only a question of time before the above ground silver stocks declined to a level where the price had to be forced higher. I think what's surprised a lot of people is the speed at which it's gone. I mean, I think a lot of us kind of were hoping we'd get to the $50 mark at some point, and probably we'd flag that for next year. And we soared through it at the end of literally the last month or two, and at an incredible pace. I think it's what's happened is easily explained in terms of the shortage of supply of silver and the demand going up. We've had the United States declare that it's a strategic metal. We've got fears about import taxes coming into the United States on silver. That's not actually happening, but it's obviously has been a fear in the year. And we've got a growing level of distrust generally about the money we've got and what's going to happen. And I think maybe it's going under the radar screen a little bit, but the introduction of the digital euro in Europe is making people think, what's my alternative?
Well, I would echo what I've just said. I don't know of anyone who expected $80 silver this early, this fast. I'm primarily a technical analyst, and I had a chart highlighting the roadmap to $50 silver in 2025, and I thought that was being pretty generous with a target of 50. I did not expect 80. However, I've long said that I think the 1970s bull market is the best analog for this current bull market, and I think we should expect to see an amplified replay, not a muted replay of that 1970s bull market. So bull markets do surprise to the upside. I do think we've got much higher to go over the long term in silver. However, this move up towards 80 really has caught many by surprise, including myself. I did not expect this fast of a move. However, I've been saying that on that 4-year cup and handle pattern in silver, a lot of people have seen that. It's been across the internet. Once you break that $50 level, the next measured move target is 96. And if you want to be a little bit more conservative, it's 88. So 88 is the most conservative measured move target on that 40-year cup and handle pattern, with 96 being the next most conservative target. So I think that's where we're headed. And, we're only within spitting distance of $80, the lower end of the target right now. I'll add too, on the daily chart, on the futures price of silver, I think it was 82.67, if memory serves correct, was the high from a couple weeks ago, or about a week ago. Well, a break above that level would be significant. We haven't cleared that intraday high, but if we do break above there, I think the path of least resistance becomes higher towards 88 and potentially even 96.
I was going to say the current price of silver doesn't deter me from wanting to buy some. Last week I was in Cron, Montana, and I went in there's a shop which sells watches and buys and sells gold. I went in twice, but he was too busy to deal with me. And I was going to go in a third time, and then of course disaster struck and the whole road was shut down, so I couldn't go there. And I went in on Monday to Degussa in Geneva, which is a major gold and silver dealer in Switzerland, and was turned away. They said, sorry, the demand is so high, we're only taking bookings. The earliest you could have a booking is Thursday. And I said, well, what's going on? Are people selling or are they buying? They said, no, it's all buys.
It's kind of funny. We could probably have lots of side discussions, but I remember a couple of years ago when we were telling our friends and family about silver, one of the most common questions was always, who's going to buy it when I want to sell it? And I would always say that's the last problem you're going to have. When it's time to sell, there's going to be everyone wanting to buy. Not suggesting now is the time to sell, but just an interesting thought.
I think the reality now is it's getting, my experience, it's getting harder to buy. The fact I had to take an appointment for Thursday on Monday shows you how long the queue is. They said, look, we can't have all these people turning up in the waiting room. I used to go in there, every time I went in, there was one or two, maybe 3 or 4 people there. but obviously it's turned one or two has turned into a bit of a crowd now.
Technical analysts see parallels between today's silver market and the 1970s bull run. Breakouts above key levels, like $50, signal targets of $88 or even $96, according to long-term patterns. Futures markets reflect intense buying pressure, with shortages visible in physical delivery and global premiums. Even small retailers report waiting lists for purchases, highlighting the gap between industrial demand and investor interest. While some newcomers hesitate, strategic accumulation remains crucial. Dollar-cost averaging and a measured approach ensure investors avoid panic decisions while benefiting from long-term gains, as silver's trajectory continues upward in an unpredictable but historically consistent pattern.
Sure. Yeah, I think we're in the early stages of that. We are beginning to see people who never asked about silver before. All of a sudden, I'm getting text messages from people I haven't heard from in 5 years saying, "Hey, you still know anything about silver? Should I buy?" So I think we are in the early stages of that, and I think there's probably multiple years to go left in this bull market. However, I like to say strategy is greater than predictions. So people always want to know, hey, what's the prediction for silver? Where are we headed in the short term with price? And I think strategy is a lot more important. So for me, like sometimes we're talking to people who have zero allocation. And if I'm talking to that person, well, I would say, hey, I would certainly be, dollar cost averaging and getting some exposure here despite the big run. Now, some people, I know there's people out there who have virtually all of their net worth in silver and gold. To that person, I would say to consider rebalancing. You don't have to be 100% in silver and gold. We waited a long time for this run. So that's just some general thoughts on strategy. But I do think we're in the early stages of this bull market, and that mass public awakening is maybe just starting to begin.
No, I've never been turned away from buying gold, whether it be from the banks. There's also a gold counter at UBS, or from Degussa, or for that matter, there's another place I go to sometimes. Not one of them have ever been so busy that they said, we're only taking appointments. It's never happened. I mean, once or twice I've been in there, certainly towards the end of last year, I noticed it was getting busier and busier. I mean, if I go back a year or two ago, I'm talking Degussa now, I would go in and I was often the only person in the shop. But over if we go back to sort of August through to December, I went in 2 or 3 times to buy coins, and there was sometimes 2 or 3 people there. I wouldn't say that was a lot, but it was a lot compared with 0 in the year before. And I'd echo what Steve said. When you're wanting to buy gold or silver, I don't think it makes any sense to go all in at once. Otherwise, you might find that the day after you bought it, there's a big dip. So the way to play the game is ease in gently, buy a little bit now, sit on it, see how you feel, buy a little bit more, maybe you'll get it cheaper, maybe you'll pay it more expensive, but it doesn't matter whether you pay either more or less. What you're doing is ensuring you will not be the person who paid the highest price ever, because you'll have paid an average of the prices over a period of time. It would hurt really if you go in and say, I'm putting all my money in silver or gold now, and then the price starts to drop and you've got to wait a month or 2 months or 3 months or 6 months for it to get back to where you paid. And that can be really, really distressing and cause people to panic and say, I made the wrong decision, get out. But going in gradually, well, then you won't pay the highest price, whatever happens. Well, first of all, if you're planning to trade in and out, we're obviously not talking here about long-term holdings, you probably shouldn't be holding the physical for trading. You should be buying paper gold or paper silver, because that has a lot less frictional cost when you go in and out, and it's much easier to trade. You can just pick up the phone or go online and trade it. So I think everybody, if they have an idea that they're going to sell at some price, they should have some of their gold or silver in a paper form. Now, I know most stackers and traditionals hate that, but if all you're trying to do is get in and get out, paper is the way to go. But on the other hand, everybody, absolutely everybody, should have some physical as the plan B. It's not anybody's liability. It's out of the financial system. And I think in the world we're in, you need to have some assets, that would include your house, of course, but other assets which aren't part of the financial system, which are genuinely yours, which you can touch and nobody can take them away from you. And gold and silver are a way to do that. And that's not the sort of thing you should be selling. So, but if you're minded to sell, you've got paper silver. One of the rules I have for everything, and that includes equities or whatever you like, but it applies to just as much to paper and silver ETFs and so forth, is when you feel the urge to sell, take a little bit of the profit off the table. And I personally tend to leave the original holding and some rolling. And I know too many people who see a surge in the price of something and say, well, I've got to grab this price because today's price is an accident and last week's price must have been the right one. The fact it's just gone up, means everybody's making a mistake because it's going to go back to last week's price. So they immediately rush to sell to grab that new price. And a week later, they're regretting it like anything because, as we saw, silver, a lot of people thought, okay, 66 silver about. And now where are we? We're eyeing we're eyeing 90. It's 81 or something like that now. So if those people who did rush to get out last week, and there were plenty of them, because a lot of people write to me about this, if they would have just sold some of their silver, they'd still be in the game. They could feel disappointed they'd sold a bit, but at least they'd still be in the game. And if it went down, they'd be happy they sold a bit.
The silver market isn't just driven by speculation. Physical shortages amplify price moves. Delays in delivery, rising lease rates, and logistical bottlenecks create tension between industrial consumers and investors. Manufacturers, from electronics to solar, race to secure supplies, fearing production disruptions. New regulations, such as China's export permissions, further tighten global availability. Strategic stockpiling in the U.S. adds to the scarcity. With demand outpacing above-ground silver stocks, prices must adjust. This real-world imbalance, combined with rising global industrial consumption, ensures silver's bull market is backed not only by sentiment, but also by tangible scarcity, making it resilient to short-term volatility.
Yeah, I absolutely love this question because going back to studying the 70s bull market, 1979 into 1980, so many people failed to take profits from what I read. I wasn't there. I was only, I hadn't been born yet. So I'd be interested to hear Clive's thoughts on if he experienced that last part of the 1979-80 bull market. But I like to say no one's going to time the exact top. So think about that. And every precious metals investor should the sell plan on what is your exit strategy. When will you push the sell button? When will you take some profits? Knowing that you are not going to time the top. No one's going to do it. So the way I do it is I have a certain allocation that I intend to have as a generational insurance policy for my children and children's children. In other words, I'm never going to sell it. Then I've got a different bucket plan to sell. And with the dollar being an ever-changing unit of account, it is not based on price targets measured in US dollars or any other fiat currency. Instead, it's ratio-based. So I have certain exposure that I intend to trade for other cash flowing assets, namely real estate and dividend stocks. And I track those ratios very closely. Silver versus real estate, silver versus a dividend ETF that I track, a dividend fund that I track. And when I can swap some metal for those cash flowing assets at predetermined ratios, I will do it. And having a plan ahead of time will take some of the emotion out of it. It's always hard to push the sell button, but having a plan ahead of time makes executing your plan a little bit easier. So swapping some for cash flowing assets when the ratios dictate makes a lot of sense for me. And by the way, we're not there yet. So I'm not doing that yet, but I have my numbers and I have my ratios in mind.
Well, I was in wealth management at the time, and I read the book called Silver Bulls, I think was the name of the book, about the Hunt brothers, and they were royally screwed over by the exchange, in my opinion. That's me expressing an opinion, because basically the exchanges brought in silver rule number 7, which basically said you can sell your silver, but you can't buy any more. And you can't take delivery. So they had a one-way ticket to sell and no choice. And of course, that because they'd borrowed money to buy all this silver, it effectively bankrupted them. Well, the supply can't and won't change very much. It probably will go up a bit this year. What happens when the demand exceeds the supply is the price has to rise, so recycled silver comes out of the woodwork. And of course, there's plenty of silver above. Well, I say there's plenty. There's less silver than there used to be above ground, but there's silver above ground, and every kilo of silver has its price. So as the price goes higher, there will be sellers, and that is what goes to meet the demand. But we've got another side of the equation. We've seen in recent weeks, and it's anecdotal evidence, that there's been a shortage of physical silver for delivery, for immediate delivery. And the reason we've come to that conclusion is the gap which has opened up between the price of silver in Shanghai and the price of silver on COMEX. Now, the two have traditionally traded within 50 cents or a dollar of each other, and that premium has gone to at times $7, $8, $9. So it was. I haven't got it. I think today I saw it was down at $5, but it's still 5 times the normal level. So that what that means is the silver isn't there for people to arbitrage it away. Otherwise, they'd be moving silver on a plane to Shanghai, they'd be selling it immediately and delivering what they've just sold the next day. So it's not happening, and that's probably because there isn't the silver to be had. People can't lay their hands on silver easily. The other slightly less provable evidence is we're hearing that the lease rates on silver are very high. I've been trying to get my hands on the current lease rates, and everywhere you ask, some people say it's 30%, some people say it's 8%. But anything over a quarter percent is another problem. It basically means that the manufacturers, not the manufacturers, the consumers of silver, the big auto companies, the solar panel companies, they need to get their hands on silver now. They've been working on what's called just-in-time supply chains, and suddenly they've realized that's a bit too risky. We better have a month's supply or 2 months supply, and now they're all rushing at the same time to say we want to be first, make sure we don't have to shut down our production line. We can't, it doesn't. If you've got an ounce of silver in a car, and it's something like this, between 0.6 and 1.8 ounces of silver per car, we're talking about the difference in the car price of going from $50 for an ounce of silver to $100. We're talking about an extra $50 on the price of a car. They're not going to shut down the production line because it costs them more for the silver. So there's this rush going on by manufacturers to say, we're not sure if this silver shortage is there, but we've got to get it, and that's pushing up the short-term price.
Investors must balance strategy over speculation. Buying in increments reduces exposure to short-term swings, while holding physical silver ensures protection against financial system risks. Paper silver or ETFs allow trading flexibility, but physical assets remain essential for long-term security. Successful investors plan exit strategies based on ratios relative to other assets like real estate or dividend funds, not just price targets. Avoid chasing peaks or panicking over temporary dips. Silver's bull market rewards patience and disciplined allocation, with a combination of physical holdings for security and paper positions for tactical flexibility, ensuring participation without emotional overreach.
Yeah, great comments by Clive. And this is admittedly not my area of expertise, but I do have general thoughts. And I think the heart of your question is, will coming new mine supply solve this supply-demand imbalance over the short term? And I think the simple answer is no. There's a lot of newcomers to the silver space, and I've even heard some generalist kind of financial advisors say, oh, well, new mine supply is going to come online with $80 plus silver. Well, it doesn't really work that way. It takes years for a new mine supply to come online. And most silver is mined as a byproduct of lead, copper, zinc, and other base metals. So it doesn't work that way at all. So the idea that a higher price is just going to instantly incentivize new production is not how it works. It takes years for that to work through the system, and ultimately, for that new supply to be released for the industrial users, the price is going to have to rise high enough that investors are willing to release their silver. Like you just said, Ed Steer, they're going to hold on to that thing with clenched fists until much, much higher prices. So it's going to take significantly higher prices for, many investors and stackers to release that silver into the market. And, an interesting potential upside kicker, and I think we're seeing early signs of this, is, industry. What if Tesla or Samsung or one of these big major companies says, you know what, this is such a critical component to our whole business model that we're just going to go straight to the miners and just take supply right from the miners. So now you'll have investment demand competing with industrial demand. So those are general thoughts, but admittedly not my area of expertise, as I primarily focus on the charts.
Well, there is another factor kicking in this year from the 1st of January. China has brought in some regulations which require exporters of silver to obtain permission before the silver is exported. Now, I've read some commentary on this. It seems that the regulations are particularly complicated, which means that only very, very large silver producers will be able to apply for that permission effectively, and it will only be granted in certain circumstances, which I think are unspecified. But what that does mean is the export of silver, which was they were a net exporter of silver, the export of silver from China to the West is going to be less going forwards than it has been. Well, I think one of the interesting plays going forwards will be what the United States does about the strategic minerals. The fact is they've now made it a strategic mineral, which doesn't mean to say they've started buying it, or at least we have no evidence that they have. But what that does is it opens the door for government agencies, such as the military, to stockpile silver. Now, the military, going back to the 1950s and 60s, did own many years' worth of supply of silver. I don't know what they did with it, but by all accounts, and I've tried to establish this, I've got the answer that it's all gone. It's all gone. So I don't know if it's in use by the military. People say it is in use by the military. But of course, the bigger use in the United States and other countries is the automotive, electrical and solar panel industries. And we're not going to have any less of any of these things. So the silver demand is only going to go up. And of course, it is critical to the continued production of these things. So can you imagine if there was some sort of disruption from Mexico to the United States, where a lot of the silver is taken out of Mexico and goes to the United States? Let's say there's some problem or something. The United States would be in a bit of a problem if they have to shut down certain manufacturing facilities, such as in the electronics industry or the data centers, where silver is a critical component for expansion.
I do, yeah, and I've got kind of an indirect answer to your question. So my primary investment thesis for silver and gold is that they are money, and they have a 6,000-year track record of doing a full accounting for the expansion of debt-based fiat currency. That's just what they always do, time and time again, and that's my primary investment thesis. Silver and gold are money. Currency is being debased, and eventually silver and gold will do a full accounting for all that debasement. Now, I look at things like you're mentioning here, export controls, stockpiling as a critical mineral, or even potentially a force majeure on COMEX as potential, just like fire on the flame, upside kickers. And I think those are very real things, but my primary fundamental thesis for investing is that they are money, and these are just upside kickers that add fuel to the flame. But I don't track that super closely, but yeah, I believe that they are factors that just are going to make this silver bull market possibly an amplified replay of anything we've ever seen before in a precious metals bull market.
Silver and gold are primary beneficiaries of currency debasement, unsustainable debt, and rising global interest expenses. Governments increasingly rely on inflation to meet obligations, with few alternatives. Financial repression, capital controls, or central bank digital currencies may emerge, intensifying demand for tangible, unconfiscatable assets. Historical precedent shows precious metals outperform during systemic currency debasement. With global debt levels escalating and fiscal mismanagement prevalent, silver and gold act as a hedge against economic instability, industrial shortages, and geopolitical risk, positioning them not just as investments, but as insurance against unpredictable financial shocks.
The fact is, I think that confidence in the governments getting their debt levels under control is diminishing. There was a little bit of hope when we had the Department of Government Efficiency, which looked like it might be starting to make some inroads until it suddenly stopped. So realistically speaking, I think we're set for ongoing expansion of debt around the world, Western world in particular. We're seeing the interest expense rise because we've come out of a very, very long period since 2008 of hyper low interest rates, got up higher interest rates. Now we're coming down again, but we're still well above the levels of interest that were being paid in that sort of 10, 15-year period after 2008. And what that means is a lot of government debt, as it starts to mature, has to be rolled over, along with the new debt, which they need to take on to fund current spending, and it's all being rolled over at higher interest rates than the interest rate being paid on the maturing debt. And people are starting to see that it's there for everybody to see, because it's on the government website, that the amount of interest being paid as a percentage of the taxes being collected is rising very rapidly. And what that means is we're approaching some sort of spiral, and we can't say when it does spiral, but we're approaching some sort of spiral when there is no end to it, and people potentially can lose confidence very, very quickly over some minor event which might happen, and suddenly everybody loses confidence, and there's a panic, and then the government can't fund itself. At that point, something happens, and I can tell you the winners will not be those who are using government debt. And I think that's why a lot of wealthy families, institutions around the world, and central banks are starting to say we don't want to have it all riding on one thing, i.e., government debt.
Yeah, I think the main drivers are currency debasement and no end in sight, by the way. So in terms of price, I think we are closer to the beginning of this bull market. In terms of time, I think we are further along. Now, I think this market probably goes to the end of this decade. Ultimately, as Clive described, the end game is, problems have solutions, predicaments have managed outcomes. And I don't see a solution to this problem. The United States and almost every government around the world that I know of is in a situation where their debts and unfunded contingent liabilities are simply unrepayable. So they have one of two choices. They can default honestly, or they can continue to inflate their currency to, make good on their obligations with debased currency units. And I think history suggests that 100% of the time, they always choose the latter. They always choose to debase the currency because people don't understand it. People don't understand inflation. If you go default honestly, there's going to be riots in the streets and the politicians are held accountable. So I think the end game is, that's the end game where we're headed to. And I don't see a scenario where silver and gold are not the prime beneficiary of that environment. Now, I see gold as very likely entering the financial system. So I see gold having a big run up and then potentially plateauing as it enters the financial system in some form, whether it's formal or informal. Where silver, I think, is more likely to have a big kind of run up and have its big pullback. That's just kind of what silver historically does. So as far as what inning we're in terms of price, earlier innings, my ultimate price target is somewhere based around $15,000, and that's based on the average of the two previous bull markets, 1970s and then 1999 to 2011. So I think we got a way to go in terms of price, but the pace of change is accelerating. Our minds are wired to think in linear fashion, not exponential fashion, and things are happening on an exponential scale right now. So things are happening fast. So in terms of time, this could all happen sooner than many think. I'm not saying in the next few months, but over the next few years, I think the world could look dramatically different, especially the global financial system, and gold will likely be a key part of that.
So I would add three things to your ending. You said obviously default or inflation, which inflation is definitely the preferred outcome. I think there are three other possible outcomes to, inverted commas, solve the debt problem. One would be financial repression. By the way, all these outcomes are very good for the price of gold. So financial repression is where you have heavy capital controls and you tell people what they can and cannot do with their money, and you enforce that. The second possibility would be one where they force people to use another kind of money. And I'm thinking along the lines of central bank digital currency here for all your transactions. And obviously, on the day one, at least, you'd understand that you can move your money freely between the money in your bank and the central bank digital currency. But there's a risk that may be blocked or limited or controlled in some way. And if they start to do that, that basically means there's now a second currency in circulation and you can't deploy or use the currency in which the government is repaying its debt. So it's repaying its debt in a currency which can't be used in day-to-day transactions. And that would, of course, effectively allow the government to start with a debt to GDP ratio of near to zero in the new CBDC, and not really care what happens to the old one because you can't do anything with it. And there was a third one, which I forgot what the third one is. It will come to me in a minute.
The silver bull market is still in its early innings, but momentum is accelerating. Historical analogs suggest a long-run amplified surge with potential targets far above current levels. Exponential shifts in demand, supply constraints, and investor adoption suggest prices could rise faster than linear expectations. Gold may stabilize within the financial system, while silver retains higher volatility and upside potential. Long-term investors should focus on strategy, maintaining diversified allocations across physical and paper holdings. The coming years could redefine wealth preservation, with silver and gold serving as cornerstones in an increasingly uncertain global economy.